Index funds and mutual funds are both types of investment funds, but they differ in their investment approach and management style. Index funds track a specific market index, such as the S&P 500. This means that they own all of the stocks that are in the index, in the same proportions. Index funds are a type of passive investment, which means that they do not try to beat the market. Instead, they simply track the market's performance. While mutual funds are actively managed, which means that a team of professional investors chooses the securities that the fund invests in. Fund managers analyze and select individual securities, such as stocks or bonds, based on their investment strategy and research. The fund's performance depends on the fund manager's expertise and decision-making. Mutual funds usually have higher expense ratios compared to index funds due to the costs associated with active management. Here are some key differences between index funds and mutual funds. Investment strategy. Index funds aim to match the performance of a specific market index, while mutual funds aim to outperform the market or achieve a specific investment objective. Expense ratio. Index funds generally have lower expense ratios since they require less active management, whereas mutual funds tend to have higher expense ratios due to the costs associated with active management. Returns and risk. Index funds typically provide average market returns because they aim to replicate the index. In contrast, mutual funds' returns can vary widely depending on the fund manager's skill and investment decisions. Mutual funds also carry the risk of underperforming the market. Transparency. Index funds have greater transparency because their holdings are publicly disclosed and are known to investors. Mutual funds may have less transparency as they may not disclose their holdings as frequently or as thoroughly. It's important to consider your investment goals, risk tolerance, and time horizon when choosing between index funds and mutual funds. Index funds are often recommended for long-term, passive investors seeking broad market exposure at a lower cost. On the other hand, mutual funds may be suitable for investors who prefer active management and are comfortable with potentially higher fees and the associated risks. It's advisable to consult with a financial advisor or do thorough research before making any investment decision.